Have you ever wondered how to start investing? A simple question, but one that opens up a world of opportunities, growth, and financial freedom. Investing, in its most basic form, is about putting your money to work for you. It's a way of setting aside a little now to reap more later. It's a journey to a future where you're not just surviving, but thriving. Now, there are many vehicles you can choose for this journey. Stocks, bonds, and mutual funds are the three main types of investments that most people consider when they think about investing. Each one has its own unique features and benefits, and understanding these can help you make informed decisions about where to put your hard-earned money. Let's start with stocks. When you buy a stock, you're essentially buying a piece of a company. You become a shareholder, which means you own a fraction of that company. If the company does well, your stock increases in value. If it doesn't, well, the opposite happens. Stocks have the potential for high returns, but they also come with a higher level of risk. Next, we have bonds. When you invest in bonds, you're essentially lending your money to a company or government in exchange for regular interest payments and the return of the initial amount you invested after a fixed period. Bonds are generally considered less risky than stocks, but the potential returns are also usually lower. And then we have mutual funds. A mutual fund is a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. Mutual funds give you the benefit of diversification, which can help spread out risk, and they're managed by professionals, which can be a big help if you're new to investing or simply don't have the time to manage your investments yourself. Investing can be a powerful tool for building wealth and securing your financial future. But like any tool, it's most effective when you know how to use it correctly. That's why understanding the basics of stocks, bonds, and mutual funds is so important. But how do you get started with investing? Let's dive deeper. Stock investing might seem complex, but it doesn't have to be. Let's break it down. Imagine owning a piece of a company without needing to show up at the office every day. That's essentially what stocks are. They give you a slice of the company. As the company's fortunes rise, so do yours, in the form of increased stock value. And if the company decides to share its profits with its stockholders, you'll receive dividends, payments made out of the company's earnings. Now, how do you invest in stocks? You'll need a brokerage account, which is like a bank account, but instead of holding cash, it holds your investments. You can open one through various reputable brokerage firms. Once you have an account, you can start buying and selling stocks. But hold on. Investing in stocks isn't a guaranteed path to quick riches. It's important to understand the risks involved. Stock prices fluctuate, and sometimes they can drop significantly. That's why it's crucial to diversify your investments and not put all your eggs in one basket. On the bright side, stocks have historically provided higher returns than other types of investments. They're a great way to grow your wealth over the long term, especially if you're patient and willing to ride out the market's ups and downs. Reputable brokerage firms like Charles Schwab, Fidelity, and Vanguard offer platforms where beginners can start investing in stocks. They provide educational resources to help you understand the stock market better and make informed decisions. And remember, investing isn't about making a quick buck, it's about growing your wealth steadily over time. So, take the time to learn, start small, and gradually build your portfolio. Stocks indeed offer great potential for growth, but they're not the only investment vehicle you should know about. Stick around as we explore bonds and mutual funds in the next scenes. Bonds, the less risky cousin of stocks, but are they right for you? Let's delve into the world of bonds. Think of bonds as IOUs issued by entities such as governments or corporations. When you buy a bond, you're essentially lending money to the issuer in return for periodic interest payments and the promise of getting your original investment back once the bond matures. Now, why might you consider investing in bonds? First, they can be a steady source of income, thanks to those regular interest payments. Secondly, they're generally less volatile than stocks, making them a safer bet, especially for conservative investors. And finally, bonds can add a layer of diversification to your portfolio, which is a good strategy to mitigate risk. That being said, bonds are not without their drawbacks. The returns are typically lower than what you might achieve with stocks. Also, while it's rare, there's always the risk that the issuer could default on their payments. And let's not forget about inflation. If the rate of inflation outpaces the interest you're earning, the purchasing power of your returns could diminish over time. So where can you start investing in bonds? There are numerous platforms out there. Vanguard and Fidelity are two well-known ones that offer a variety of bond options. They're user-friendly and offer resources to help beginners understand the bond market. You also have the option of bond mutual funds or bond ETFs, which give you exposure to a broad range of bonds in one fell swoop. Remember, while bonds are generally less risky, they're not entirely risk-free. It's crucial to do your due diligence and understand the terms of the bond, the credit worthiness of the issuer, and the interest rate environment. Investing in bonds is not about making a quick buck. It's about preserving your capital and generating steady income over time. While bonds offer relative safety, mutual funds provide a balance of risk and reward. Stay tuned as we'll delve into that next. Mutual funds, the perfect blend of diversity and simplicity. These investment vehicles are essentially a pool of funds collected from many investors that are managed by a professional fund manager. Think of a mutual fund as a basket. Instead of buying a single apple or orange, you're buying a basket full of different kinds of fruit. This basket represents a diverse portfolio of investments, which could include stocks, bonds, and other assets. The primary aim? To distribute risk and potentially increase returns. How does this work? Well, when you invest in a mutual fund, you're buying shares or units of the fund. The value of these units changes as the value of the assets in the fund fluctuates. The fund manager, who is like the captain of a ship, makes decisions about what to include in the fund, aiming to generate returns for investors. Now, let's talk about the pros and cons. The biggest advantage of mutual funds is diversification. By investing in a variety of assets, you can reduce the risk of a single investment performing poorly. Additionally, mutual funds are managed by professionals, providing a hands-off approach to investing, which can be great for beginners or those who don't have time to monitor the markets regularly. However, there are also some downsides. Mutual funds often come with fees, which can eat into your returns. These can include management fees, distribution fees, and other charges. Furthermore, because a fund manager makes the investment decisions, you have less control over the individual investments in your portfolio. If you're considering investing in mutual funds, some reputable companies to consider include Vanguard, Fidelity, and T. Rowe Price. These companies offer a wide range of mutual funds, catering to different investment goals and risk tolerances. So, you've got the basics of stocks, bonds, and mutual funds. What's next? Stay tuned as we delve into the final scene of our Investing 101 journey. Investing can be a powerful tool for building wealth. This is a statement that has been proven time and time again. Today, we journeyed through the fascinating world of investing, focusing on three key areas: stocks, bonds, and mutual funds. In the realm of stocks, we discovered that they represent ownership in a company. When you buy a stock, you're essentially buying a piece of that company's future success. We also discussed the potential for high returns, but cautioned about the inherent risks. Remember, the price of a stock can go up, but it can also go down. Next, we explored bonds. Unlike stocks, bonds are essentially loans that you give to a company or government. In return, you receive regular interest payments and the promise of your money back at the end of a set period. We highlighted the relative safety of bonds, but also their lower return potential compared to stocks. Lastly, we delved into mutual funds, a popular investment vehicle that pools money from many investors to purchase a diversified mix of stocks, bonds, or other assets. Mutual funds offer a way to achieve instant diversification, even for those with limited capital. But, as with any investment, they come with their own set of risks and costs. Throughout our discussion, we emphasize the importance of doing your own research, diversifying your investments, and adopting a long-term investment strategy. It's not about timing the market, but time in the market that matters most. Now, it's over to you. Whether you decide to invest in stocks, bonds, mutual funds, or a combination of all three, remember to consider your own financial goals and risk tolerance. And, of course, never hesitate to seek professional advice if you need it. Thanks for watching. Don't forget to subscribe, share, like, and leave a comment if you found this video helpful. Remember, the best time to start investing was yesterday. The second best time? Today.